What if I told you that the people who absolutely panic and sell everything when the stock market crashes are doing the exact opposite of what actually makes millionaires? And what if I told you there's a dead simple strategy, one used by everyday people, not just Wall Street pros, that quietly builds serious wealth in the background, literally no matter what the market is doing? Well, welcome to this explainer. Today, we're going to master the market through a concept that sounds, honestly, a little too good to be true, but it's rooted in pure mathematical reality. By the end of this, you're going to know exactly how to defeat the single biggest enemy of your investment returns. And spoiler alert, that enemy isn't the economy, it's you. Okay, let's dive right in.
So what if market crashes actually build wealth? I know, that feels completely backwards. We are so conditioned to just run for the hills the second those red arrows start flashing on the news. But here's the truth. Panic selling absolutely destroys portfolios, while strategic, steady buying during a downturn is exactly how generational wealth is built. To really understand why, we've got to look at how we naturally behave as human beings.
Think about the typical emotional investor. They see the market going up, they get super hyped, and they buy in, usually right at the peak. But then, the inevitable happens. The market dips. They freak out, they sell, usually right near the bottom. Then they sit on the sidelines, waiting for things to feel safe again. The market recovers, and this vicious, money-losing cycle just repeats itself. Now, contrast that with the market itself. Over time, despite all the scary bumps and drops, it historically shows steady growth. Studies actually show that your average retail investor dramatically underperforms the market over the long haul. And it's not because they picked the wrong stocks, it's because they let fear and greed completely hijack their timing. So, how do we fix this?
Well, you take human decision-making out of the equation entirely. Enter dollar cost averaging, or DCA for short. This is simply investing a fixed amount of money at regular intervals, completely regardless of what the market is doing. Every month or every week, no matter what. Let's say you decide to invest $200 every single month into an index fund. Some months the market is way up, so your $200 naturally buys fewer shares. Other months the market is down, so that exact same $200 naturally buys more shares.
Now I get it. The mental shift this requires is huge. You're probably thinking, wait, the market going down is actually good for me? When you're consistently investing using DCA, absolutely. Think of a market dip as basically a giant clearance sale. And with dollar cost averaging, you are automatically showing up to that sale every single month. Instead of having a mini heart attack when prices drop, you just stay the course. Because the strategy is doing all the heavy lifting and thinking for you. You're just scooping up shares at a massive discount without having to lift a finger.
All right, let's look at the math behind the magic. And don't worry, I promise there is no advanced calculus here. We're going to walk through a concrete 3-month mathematical example so this concept really truly clicks. Let's say it's January and a share of an index fund costs $100. You invest your steady $200, which gets you exactly 2 shares. Simple enough, right? But February rolls around and the market takes a massive hit. The price plummets to $50 a share. Now, most people are absolutely panicking here, but not you, because your DCA is on autopilot. Your $200 investment goes in just like normal, but because the price is literally cut in half, you just bought 4 shares. Then, in March, the market starts to bounce back a bit, and the price goes up to $80 a share. Your $200 buys you 2.5 shares.
Okay, so here is the massive light bulb moment, $70.59. Let's tally up that quick 3-month journey. You invested a total of $600. Because you kept buying straight through that scary dip, you accumulated 8.5 shares. If you divide your $600 by your 8.5 shares, your true average cost per share is only $70.59. But remember, the current price in March is $80, meaning you are already ahead. You're making a profit, even though the market literally crashed right in the middle of your journey, and you never once had to stress about guessing the perfect time to buy.
Because think about it, if you had tried to manually time the market, you might have bought in at 100, panicked and sold everything at 50 and locked in a devastating loss. DCA removes that temptation completely. It proves one of the most absolute, powerful truths in all of personal finance. Time in the market beats timing the market. DCA is the ultimate strategy that keeps you in the market consistently without you needing to be some Wall Street genius to pull it off.
So, who is this actually for? Is it for beginners or the pros?
Well, the answer is both. And honestly, here's a fun surprise for you. You might actually be doing this right now. If you have a 401k through your employer, where a fixed amount of money gets pulled out of every single paycheck and dumped into your retirement investments, congratulations, you are already dollar cost averaging. Millions of people do this every 2 weeks without even realizing there's a fancy finance term for it. It's literally the perfect on-ramp. You don't need a giant pile of cash to get started. You just need consistency. But okay, what if you do have a giant pile of cash? Say you get a big inheritance or a massive year-end bonus at work. Let's address the math on this head-on. Research actually shows that if you have a lump sum, investing the whole thing all at once beats dollar cost averaging about 66% of the time. Yep, 2/3 of the time the lump sum mathematically wins simply because, historically speaking, the stock market generally trends up over time. But, and this is a massive but, the best investing strategy is the one you can actually stick to. Imagine this. You invest a $50,000 lump sum on a Tuesday, and on Wednesday, the market drops 20%. The psychological pain of that is just immense. Most people will totally panic, sell everything to stop the bleeding, and turn a temporary paper loss into a permanent real one. DCA spreads that money out. It keeps you sane, it keeps you invested, and it totally prevents you from making an emotionally disastrous decision. It is the ultimate psychological victory.
All right, let's get into the 3 steps to start doing this today.
If this is finally clicking for you and you're ready to take control of your financial future without dealing with the daily stress, I've got a really simple roadmap for you. Step 1, open a brokerage account. You want to look at trusted platforms like Fidelity, Vanguard, Schwab, or even automated apps like M1 Finance. Step 2, pick a broad, low-cost index fund. You're looking for something like a total stock market ETF or an S&P 500 index fund. These give you super low fees and instant diversification across the whole market. And finally, step 3, and this is absolutely the most crucial one, set up automatic contributions. Pick a dollar amount you can genuinely afford, put it on autopilot, whether that's weekly or monthly, and then just leave it alone. Seriously, don't log in and watch it every day. That set and forget consistency over time is exactly what separates the people who just talk about building wealth from the people who actually do it.
Next up, let's tackle some common fears and myths.
Now, I know there's a little voice in the back of your head right now saying, okay, but what if the market just keeps going down for years? Doesn't DCA hurt you then? Look, yes, there are totally brutal rough patches. We had the devastating market crash in 2008 and that terrifying steep COVID-19 drop in 2020. But here's the historical context you need so you can actually sleep well at night. The U.S. stock market has literally never failed to recover and reach brand new highs over any 20-year period in its history. The folks who just put their heads down and kept automatically investing through 2008 and 2020, they came out massive winners because they were quietly buying up shares at rock-bottom prices that whole entire time. DCA is not a get-rich-quick scheme. It is a get-rich-slowly-and-surely strategy.
Another question we get all the time is about crypto. Does DCA work for incredibly volatile assets? And the answer is yes. Actually, a lot of investors heavily rely on DCA for assets like Bitcoin, precisely because it strips the extreme emotion out of those wild, unpredictable price swings. But please keep in mind that crypto carries significantly more risk than a boring diversified index fund, so if you're applying DCA there, you need to have a very honest, strict conversation with yourself about your own personal risk tolerance. And hey, if you're sitting there right now thinking, I just don't have enough money to start doing this right now, let me introduce you to a very, very important number. $1 single dollar. Because most modern platforms offer what's called fractional shares, you can quite literally start this process with $1. The actual dollar amount matters so much less than just building the habit. Start tiny, stay consistent, and then just bump up your contributions as your income grows over the years.
To bring this all home, I want to leave you with this famous thought. Albert Einstein allegedly called compound interest the 8th wonder of the world. Dollar cost averaging works so incredibly well because it completely neutralizes the 2 things that absolutely destroy most everyday investors: fear and greed. You don't need to be psychic and predict the future. You don't need to religiously watch the financial news. By just consistently buying at every single price point, lowering your average cost automatically, you are firmly placing yourself right inside the magic of compound interest.
So my final question to you is simply this. Are you ready to get out of your own way and let time and consistency build your wealth? If this explainer shifted how you look at investing, do me a favor and share it with someone who really needs to hear it. And if you haven't yet, make sure to hit subscribe. We are going to keep breaking down these complex money concepts in plain, jargon-free English so you can finally take total control of your financial future. Thanks so much for joining me, and I'll catch you in the next one.